Would your current business and financial resources allow you to retire today? If not, when would they? Answers ahead in today's show. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors to help business owners enjoy more freedom, grow companies faster, and retire someday on their own terms. Joining me again today is Tom Baer, Springfield, Illinois CPA, certified exit planner, and a partner with the accounting firm Sickich. Welcome back, Tom, and thanks for joining us. Tell people about how their personal and business financial resources fit into the exit planning process.
You bet, Norm. Thanks for having me.
So today we're going to hit 5 key elements. One is why do you need a valuation for your company? Number 2, might seem confusing. I mean, most people would think you want the highest possible valuation when you sell your company, but that may not be true. And again, this is the same old thing we've heard over and over again, the role the cash flow plays. And then another element we need to talk about is what happens when the amount you need doesn't mesh with reality and there's a gap. How do we bridge that? And then also, I think we should talk about a little bit about how this correlates with the 5 essentials of the last episode, although this is becoming pretty evident that cash flow and management and all these things are just recurring themes. So first question up is, why would someone want to get an actual valuation done for their company?
Norm, one of the big mistakes I think business owners make is when they go in to see their attorney and they start to talk about their estate plan. One of the assumptions they put out there is the value of their business. So they sit with their attorney and they collect information about all of their assets, their insurance policies, everything they have. And the biggest asset generally in a business owner's estate is his business. And they really don't necessarily have a good feel for the value of the business. If they're active in their industry, they probably are active in the trade association. The trade association may provide some information about multiples of value ranges, and they may have some idea of what the value of their business is, but until you actually sit down with a valuation professional and go through a process where you understand the risk of your industry, what the true cash flow is, and what the future of your business holds, and all of those factors play into things like discounting, the cash flow of the business, and overall will affect the value of the business. You really don't necessarily know what that value is. So the most important reason to get the value of the business is so that you have some scientific proof to yourself of what that business, what kind of liquidity that business could bring if you were to sell it, and how that plays into your overall exit plan. Because remember, from step 1, how much is really one of the critical things we have to figure out. How much do you need in retirement? So one of the questions I'll ask a business owner who doesn't really want to incur a lot of expense to get a valuation is, if the business represents, let's just say, 80% of your total estate value, and you're very, very reliant on the liquidity coming from that business in order to retire and enjoy the life that you imagined in retirement with your spouse, that's a pretty big risk to take to not get a valuation done, or use some professional to help you really understand what kind of value it has. So, there's a lot of risk there if you decide not to incur what really becomes a fairly small cost to get a valuation done.
Okay. So, in any buyer, in the end, a buyer is going to have a valuation done anyway, so you're going to have one at some point, so It's probably a good idea to have it in the beginning.
Right, and the other thing is, if you're going to sell your business to a management team, getting a valuation done, and you can get a valuation done fairly efficiently from a cost standpoint, really adds a lot of credibility to provide. You provide that valuation to your management team and say, here's kind of the value of the business, and it gives you a lot of credibility and lets them know that you've hired an outside professional to give you advice.
Okay, good. So we'll have some interviews coming up here with actually with valuation experts, and they'll tell you about this, how all this process works and everything. So when you have your company valued, I'd like to think if I had my company valued, I'd want a real big value on it, especially if I'm selling it to somebody.
Sure.
But why is that not always true?
Well, a valuation professional would probably tell you there's a range of value in your business. So if you get a valuation done, which effectively is just a professional who's trained in valuation giving you a report after they've gone through a lot of financial and industry information about your business, they give you a report that gives you a value. And they may give you a report that gives you a range of value. So let's talk about a low value. Typically, a business owner that's going to gift their stock in their business to their family members, maybe they're doing some estate planning, they would prefer probably to have a lower value, because a lower value means you might be able to gift more and over time get some value out of your estate to help minimize your estate taxes. So that might be a reason that you'd want a low value. You'd want a high value, obviously, because at the end of the day, you want to maximize your proceeds from the sale of the business. So the high value would be a goal of a business owner that was trying to maximize liquidity out of the business.
Okay, so you have the high value and then you have the low value. So how do you? But it's the same business. So how do you justify valuing something lower that in another scenario might be valued higher? How do you go about doing that?
Well, my easy answer is probably ought to ask a valuation professional that. But, I think what you would hear from a valuation professional is you really don't know the true value of a business until you put it on a market and actually enter into a contract and close a transaction to where the buyer pays for the business. That's really the only way we know what the market will bear for a business.
Okay.
So short of that, we follow a process, valuation professional will follow a process, and they'll come up with a value that, based on their expertise, they think the market might bring that value.
Okay. So once you assemble your team too, you talk to your attorney and all the team, and maybe come up with some ways to make that fit the model that you're going to follow in terms of your exit path. Cash flow. I don't know if we need to belabor cash flow.
Well, one of the things on cash flow, Norm, in the valuation world, you'll hear a lot of talk about free cash flow, or this term called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And those are terms you'll hear quite frequently when you're talking to investment bankers or to valuation professionals to help determine a value. One of the things I would caution folks on that is what isn't included in that calculation in a lot of cases is deferred maintenance, where the business hasn't really spent a lot of money on capital expenditures. They've pushed those off because they really don't want to incur debt, or they don't want to incur the cash flow. We like to actually look at what's the capital expenditure budget need to be over the next 5 years to really maintain the business and the revenue that they're generating. And that might include some technology. It might include really upgrading their internet presence, as an example. So EBITDA is a good measure, but if a business hasn't really invested in itself adequately, I would argue that EBITDA isn't necessarily the right measure. I think you need to take into account what the capital expenditure budget is over the next 5 years, and maybe actually reduce that EBITDA a little bit.
Okay, that's a good point, because I can see someone who's looking at maybe retirement 5 years from now, thinking, well, I might as well cut back and let some of this stuff go and maybe set aside a little more money for retirement, put it somewhere else in the business where it'll create a lump of cash for me later, but that may actually cost you more than it gets you in the long run.
It might, and on the other hand, if you believe that your exit path is going to be selling to a competitor, and that competitor has already made a lot of those investments, it might be the right decision for that business owner to cut back on their capital expenditure. Maybe they need to upgrade their management systems, their accounting systems internally, but they know that that's going to create a lot of cost and a lot of headache and another project they really don't want to go through. If they know that they're going to sell to a competitor, they may want to wait and just allow that competitor to take all of their systems, all of their customers, and all of their activities and just integrate them into their system, and therefore they really don't have to incur those costs.
Okay, good. Never thought of it that way. That's probably all that comes out when you do your questionnaire and you plan ahead and think about these kind of things.
Right.
Okay, good. Okay, last part, folks, is how does this fit back in with the 5 essentials we talked about before? The one that comes to mind is time to me, but there were some others. Anything that we need to add that kind of tie those two together?
Well, I think the one thing that comes out a lot when you start to talk about business value is potentially there's a gap. In other words, a business owner in many cases thinks that their business is worth more than it really is. And so their perception is that they will be able to create some liquidity from their business, combine that with their other personal assets outside the business. Maybe they own rental property, maybe they have an investment portfolio, whatever those other assets are, and those are going to create enough cash flow for them to live comfortably in retirement. So when the business value comes in at a level that's below their expectation, that really changes their plans. So you talk about time, there may be a need to execute a strategy to help build the business up, to generate more cash flow, to get the business to a level to where they're going to be able to sell it for the right amount of money and generate the kind of retirement cash flow that they're going to need. So time is a factor in a lot of cases. And like I said, one example is where there's what we call a gap in expectation, where the reality is a business is probably worth less than what they originally thought it was.
Okay, good. So I think we've hit all those. Parting advice?
Well, again, I think we're hitting here, Norm, on the question of how much, and I think it's a two-part question. I think you've got to know what resources you have currently outside the business, and I think you got to understand the value of the business. And you take all of that and you go through somewhat of a financial planning exercise, and it's important for you and your significant others to be involved in that, because you may have some things you want to do in retirement that may consume a lot of that liquidity. You may want to buy a house in Italy. You may want to buy a boat and move to Florida. So all of those things are going to take some liquidity, and they're going to put it into an asset that's not going to generate any cash flow. So you really have to make sure you've got a good understanding of what your cash flow is going to be and what the value of the assets you have are.
Okay, so if you like today's show, please visit our website, exitplanshow.tv, and leave comments or ask any questions you want to ask about today's show or anything else for that matter. And if you'd like to talk to Tom about his services, you can find his information there too in the show notes, and we'll also have a link to his website and some other contact information. So don't forget to visit our website and leave your comments below the show notes, and Tom and I will see you back here for episode 9.